from a long-term perspective, I think India offers great opportunity to every investor. This is where you have people who are talented, people who are hardworking, and any kind of service anywhere in the world. You need to be anti-fragile, and anti-fragile is basically you become better when there is a stress or when there is a crisis. And I think this is what India is preparing over the last couple of years, whether it was COVID, whether it was 22 when oil prices went up, or when the recent last couple of months of some of the moves by the US. What we are trying to do is not only managing the crisis, not only kind of trying to be resilient, but what we are trying to do is that this crisis should make us better. So I think the wealth creation formula is sound investment plus time plus patience. Importance of asset allocation should never be neglected. I mean, you have seen equity was doing so well. Now you have seen this year where precious metals have done well, fixed income yields have come down. I think one should remain diversified across all asset classes. Between 1982 and 2002, gold prices in dollar terms fell from $800 to $250. Never forget that. Never forget that.
Today we are turning the spotlight on a CA turned market strategist who believes in creating long-term value for investors. He runs an asset management firm that looks at assets worth over 7.5 trillion rupees. And let's peek into what he thinks, what drives his decisions, and what lessons investors could pick from the conversation that we're going to have about the new Samvat here. So we have with us today Mr. Navneet Munot. He's the MD and CEO of HDFC AMC. Hello, Mr. Munot.
Thank you, Deepti.
So let's get started with the conversation. The first thing that I want to ask you is that you've had a very colorful journey. You came from a very small town, and now you're heading HDFC AMC. So you've seen the investor behavior evolve over these years. So is there any interesting bits that you could probably point out?
Thank you, Deepti. And a large part of the country lives in a small town. And I take pride
absolutely.
I grew up there, but Mumbai is just an amazing place, and it's a heart of India's economy. It's the heart of India's capital markets. And I've seen the journey investing in 80s and 90s, early 90s, from a small town to where the markets are today. And I think every Indian must be very thankful to our policymakers, our regulators, and a lot of other people who have created outstanding institutions. In 80s, I remember that I used to get a newspaper which was like a day older and reading a price of the previous day. So I'm reading prices which were like 2 days before, and there used to be physical certificates. There used to be you had to send it for transfer, which takes several months. And now with the online trading to dematerialization to the kind of transparency that we have got, we have come a long way. From a behavior perspective, I would say a lot has changed and not much has changed. Why that's contrast may sound contrasting is that a lot has changed, meaning people didn't understand something like an SIP, that they need to invest for long term. They need to be disciplined in their investing. I think that's more like last 10-15 years, while the industry has been working for much long. Nothing much has changed, meaning there are still a lot of investors who chase short-term returns. There are still investors who have a recency bias, or if I can say a bandwagon effect, so on and so forth. Those are fundamental to human beings. Greed and fear, those are fundamental. But within that, I think investors are a lot more resilient, a lot more disciplined, and understand the power of compounding, unlike the way they were investing in 80s and 90s.
So do you think that earlier they were chasing quick gains and now they've probably become more mature?
I think at least a part of the investing population today who believes in the power of SIP, I think they are clearly the ones who are looking at investing very differently today than what they would have done. And earlier it used to be more about a bull market and bear market, that You need to time the market, you enter the market at the right time, at some stage you book profit, and there used to be like those cycles I'm talking about, let's say what I've seen in 84, 85, 91, 92, 99, 2000, 2000, like 5 to 8 cycle, and it used to be more like cyclical. Now we are seeing investors who can see a 30-year track record of funds and are taking a very, very different call and looking in a highly disciplined manner. I must give a lot of credit to all our distribution partners, and of course the role media has played actively in sensitizing investors towards long-term disciplined investing.
Also, how has this behavior changed among the first-time investors?
So thanks to the information available, thanks to efforts made by the mutual fund industry and all the other ecosystem partners, now investors are a lot more guided than what they used to be. It was more like keep experimenting with various things. Now they know that there is a way for them to do their goal planning, for them to do their asset allocation, fund selection, and then create a portfolio and then do a rebalancing. Investors have more curiosity today. There is more willingness to learn, willingness to kind of look at it more holistically.
So, retail participation has also increased lately in the market, and a lot of investors have entered during the COVID and post-COVID period, and they've seen like quick buck gains. So what do you make of them, and what do you suggest those kind of investors, especially now when the markets could kind of remain like a little muted for some time?
So you are absolutely right. A good number of investors have entered the market in last few years. Some of them in the initial part of, let's say, post-COVID recovery till September 2024 had much higher return than what long-term expected returns would have been. If you go back a year, exactly the same time, 1 year return would have been like 30-40%. Even 2 year returns were very, very similar. This has been the year of consolidation where market hasn't delivered much, while mutual funds by and large have done better than the market, but still returns are lower than where, let's say, they were a year or two back. My sense is that good number of investors understand that, and they understand that you cannot have equity market returns in a linear fashion where every year you will get 20-30%. That's not the nature of the beast. Volatility is an integral part of the market, and I hope that they maintain their discipline and continue investing with a long-term orientation.
And long term also kind of averages out the gains then.
Absolutely. Yeah. Even today, in fact, it's interesting. So 1 year Nifty would have been like flat. If you look at small and mid caps, they would be like marginally 2-3% here and there. But if you look at like 2 year returns, even today they are very interesting. Like it's more than 15-20%. A 3 year is still very high. A 5 year is still very high. So you have to go through some periods of those consolidation. Yeah. And this is what we used to talk about a year back for several months. Most of our fund managers, most of us in the industry used to say that you can clearly see the valuations were running ahead of fundamentals. You could see narratives taking over numbers, and this cannot sustain for long. At some point in time, there would be a period of consolidation or correction, and we have seen time correction of 1 year at least, and some bit of price correction.
What do you make of the valuations now? Do you think it's still expensive?
So as I said that because we have seen a time correction and there has been some earnings growth, while of course lower than the expectations, valuations have come down a little bit. One has to take a little longer term view on the economy and on the markets. In the very near term, I would say valuations are, I mean, these could be called like a fair valuation of the market from a long-term perspective, not from a short-term perspective. Yeah.
Actually, it's also quite interesting because Nifty has been lagging behind most global markets also. So, I mean, especially now that Trump also kind of imposed, new tariffs on China. So, how does that make India look, in the investment playbook?
I think if you scan the global economy and the global markets, we are in a world which is geopolitically realigning, a world which is digitally redesigning. I think AI is a transformational force, a world which is demographically diverging. I think a large part of the world is aging and aging very fast, particularly the economies like China, which have been a driver of global growth for last 20, 30 years. They are aging very fast. While India, I mean, we have a
Still
best
growing.
of our demographic dividend over the next several decades. A world where there's a lot of leverage, particularly in the developed world, while Indian, I think the balance sheets have been in best ever shape. So whichever way we look at it, I think we feel very positive about India from a long-term perspective. And I always quote this, that if you look at political, social, macroeconomic and financial stability, in one breath you can talk like this for many other countries in the world. So I think we are very fortunate that we are in India this point in time. Last 1 year, while most of the other markets have performed better than India. You look at MSCI World, you look at MSCI Emerging Market, Developed Market, United States, even Japan, several of the other markets have done better than India, simply because I think we had 2, 3, 4 years of exceptional performance, and now we are seeing a period of consolidation. But from a long-term perspective, I think India offers great opportunity to every investor.
I mean, it might be a cliche question, but like foreign investors have been selling. So when do you think they could probably come back to India?
So over the last 30 years, foreign investors, except the last 3, 4 years, for longest period of time, foreign investors have been a net positive investor in India for two reasons. Number one is a top-down opportunity. I mean, a democratic rule of law, a good growth environment, low penetration, economy growing from a very low base, a structural opportunity was very large. So that was a top-down reason for them to invest. The second is the bottom-up opportunity. Unlike many other emerging markets where the universe would be very small, in India you get large number of very high quality companies, good business model, I mean good governance, growth orientation, good return on equity, and run by world-class management, good disclosure, so on and so forth. So because of the top-down reason on one side and the bottom-up opportunity to pick stocks, they have been a net buyer. Last few years, I think some of the other, last 1 year in particular, some of the other markets have done better than us, but I remain confident that given, I mean, both the top-down opportunity is not changing, the bottom-up opportunity is only becoming better because large number of companies are accessing secondary market now. You are seeing a lot of primary issuance, and you will see the universe expanding. And at some point in time, I expect foreign investors to be net buyers of Indian equities again.
In the new Samvat, you mean?
I think so. I think so. And my view is that the US exceptionalism and also this, while I quoted earlier that AI is the most transformational force humanity has ever seen, at the same time, from an investing perspective, I think the whole AI trade is getting overextended. Or maybe I think moving in the direction of getting overextended. At some point in time, I think we are going to see investors looking at
Beyond that, probably.
Beyond that. So if you look at the markets that have done well, in US there's a small cohort of stocks that have done well, which are basically a play on the AI. You see in China, you see in Japan, you see in Korea, you see in Taiwan. It's largely the AI trade. I think India is the one who has historically been the best adopter of technology. If you look at our digital public infrastructure, we have basically taken advantage of, let's say, massive investments that have been done somewhere else. We have provided the cheapest data to each and every Indian in India in last 10 years. So while several of the companies would have won tens, if not hundreds of billions of dollars on building that, the capability. But in India, I think we have been a great adopter of technology. There could be something similar in AI as well. There could be many businesses in India, which are the traditional businesses, and many businesses which will get built now, leveraging on what AI can offer. So at some point in time, investors will look at from that lens, yeah.
The point that you mentioned about the universe expanding, Indian equities universe expanding, a case in point is how the SME universe has been expanding. I mean, small businesses picking up and wanting to go to the listing route to raise money. That also shows how India is expanding as a growing economy.
So I don't track that market as much. I mean the SMA listing, but I mean India is a land of entrepreneurs. I mean every large company today was a small company one day, and one of the interesting thing about Indian economy is the capital market. I think our capital markets have actually been are comparable with the developed markets, giving an opportunity to every entrepreneur to raise money.
So actually going into the new Samvat, what would you probably, suggest investors? Should they, like you spoke about discipline and chasing returns.
Yeah, yeah.
So either of the two, like would you suggest chasing returns or staying disciplined?
Always staying disciplined, yeah. I mean, if you get lucky and markets delivers you much more in a 6 month or 1 year than what you expected, that's pure luck. But I think the longevity is more important than making return in the short run. Longevity is more important than making returns in the short run.
Also, how would you, probably summarize the last somewhat here? Because we've seen a roller coaster of events related to Trump and tariff, and we've seen wars between countries, geopolitical, lot of geopolitical stress for investors. So the volatility has been high all the time. So, any key takeaways from that?
So talking about the world, I use this line may sound like cliched. The world we are in, the world we are in, the only thing I can say with certainty is continuity of uncertainty. And I think this is likely to stay like this for at least for the foreseeable future. I mean, not only the last 1 year, look at last 5 years. Then 2020, beginning of the year looked like a good year, and suddenly we got hit by COVID, the biggest and health crisis in a century, biggest economic crisis in a century. 21, we started like, okay, we'll be post-COVID, things would be back to normal, and we got hit with the lethal second wave. 22 started with like, okay, vaccination done, things would be back to normal and economies would roar, and then you had Russia-Ukraine war, and then you had like oil prices going up, inflation going up, interest rates, even in developed world going to like much higher level than what anybody would have thought in last 30 years. And I can go on for every year. There are three things about the world. Everything is unpredictable, everything is faster, and everything is questionable. The third part I will explain, that the first two are like self-explanatory. The third is there is so much of information, so much of the data points get thrown to you in today's world of like so much of noise. You really don't know what is like signal and what is noise.
About Indian equities, I mean, how are you looking at, what's your reading of like the situation ahead? Like, do you think there could be the subdued moment continuing, or do you think there might be some triggers like earnings growth which will probably lift Indian equities from here on?
So last 1 year, as we discussed earlier, has been a period of consolidation. Even the earnings growth have been below the market expectations. But thanks to our policymakers over the last couple of months, several actions have been taken, right from the relaxation in personal income tax to the cut in the GST to efforts that RBI has made in terms of releasing more liquidity, cutting interest rates, supporting the credit growth. All of these should lead to consumption, particularly one of the pillar for the economic growth, not firing as much, should start firing. We are already seeing the festival season. I think everybody has been watching very closely and everybody has been optimistic. Over the last couple of years, government has done a good job on the capex, and if the consumption picks up, we see a higher growth thanks to efforts of all our policymakers. And then over a period of time, we are going to see return of private capex as well. And it could be a more broader based or a broad based recovery than what we have seen in last couple of years. And that should lead to over a period of time earnings growth becoming better than what we have seen in last few quarters.
So for a medium risk appetite investor, how should they even look at rebalancing their portfolio between equity, debt and gold? We've seen gold and silver skyrocket. Silver physical delivery has been like at a crazy premium. So I mean, would you recommend them rebalancing?
So investors should always do that. They should do their asset allocation and then should keep rebalancing depending on the market movement. One of the easier way to do that is what our mutual fund industry has done, is providing the options of investing in hybrid funds, or what we call like asset allocation or multi-asset funds, where as the market move, the fund manager automatically reallocates that money to the asset class which hasn't done as well. So if you're investing, let's say in a hybrid equity fund where 2/3 goes in equity, 1/3 in fixed income, if equity markets are going up rapidly, automatically the portfolio gets rebalanced. So one way for the investor is to invest through the asset allocation and the hybrid funds.
What could be the factors that we need to watch out for going ahead?
So there are three kinds of risks. There are known, there are known unknown, and there are unknown. What we have seen in last couple of years is every few quarters you get something which is absolutely unknown. We can't even visualize, we can't even think what we may get hit by, but you have to live with that. Known would be like the uncertainty which has been caused by the whole tariff war. You have seen just very recently what US announced on China, what they've announced on India. I think the whole geopolitical environment has been highly uncertain. The global environment has been highly uncertain. But amidst all of that, I think what the faith we need to have at that, I think the overall the fundamentals of Indian economy are strong. We have good balance sheets, both corporate balance sheet and the financial sector balance sheet. I think the policymakers have been trying their best to support growth, and I'm very sure that the technological changes which are underway, while India may not be spending tens or hundreds of the billions of dollars that we are seeing in some of the other parts, but I am hopeful that we will be one of the best adopters of these technological changes.
Also, are there any risks or even tailwinds that you're noticing in this subdued market?
I mean, tailwind is $2,500 per capita GDP. I mean, half the population which is below 25 years of age. You have multiple drivers of growth. So, I mean, whether you look at manufacturing, China +1, whether you look at like in services, whether you look at whether in consumption or in investments, even in services exports, while people have been worried about the whole H1B visa movement, etc. But think about it. This is where you have people who are talented, people who are hardworking, and any kind of service anywhere in the world. Now with the way technology has been moving, I think the opportunity is only going to be
increasing,
larger. Absolutely.
Are there any risks wearing a wealth manager's hat? Do you see any risks?
As I said earlier, known unknown, and unknown. You have to be prepared for that. And there's very interesting thing by Taleb, that it's not enough to be resilient. You need to be anti-fragile, and anti-fragile is basically you become better when there is a stress or when there is a crisis. And I think this is what India is preparing over the last couple of years, whether it was COVID, whether it was 22 when oil prices went up, or when the recent last couple of months of some of the moves by the US. What we are trying to do is not only managing the crisis, not only kind of trying to be resilient, but what we are trying to do is that this crisis should make us better, and not just living through it or just kind of like staying through it.
With the PLIs also.
Many things, so, many things,
So, any one, Samvat mantra for investors?
I always quote this. I think the wealth creation formula is sound investment plus time plus patience. Sahi nivesh, lamba samay aur sanyam. If you don't have these three, then you don't create wealth in the long run. The nature of the beast is volatility. Equity markets would be like that. I think we need to have that long-term faith. Importance of asset allocation should never be neglected. I mean, you have seen like equity was doing so well. Now you have seen this year where precious metals have done well. Fixed income yields have come down. I think one should remain diversified across all asset classes.
Actually, one question out of curiosity. So, how do you see gold and silver performing like going ahead? Do you think that there could be like a time price correction there as well?
I think the momentum has been very strong over the last couple of years, and in fact, our fund managers and our team had been recommending allocation to gold and silver. People have the best way to invest it through the ETFs and the gold fund and the fund of fund, etc. I would just recommend one thing, that the power of asset allocation should not be underestimated, and one should not extrapolate these returns. It cannot deliver 50% every year. It's been like 50% this year. Over the last couple of years, it's done very well. There's such a uncertain environment. This is like a vote against dollar in a way. It is a vote in favor of like maybe I think it's a people's fear about many things going wrong in the world. Central banks are buying, individuals are buying, institutional allocation is low. At the same time, if you go back in history, there have been long periods where gold and silver underperformed, very long period. Between 1982 and 2002, gold prices in dollar terms fell from $800 to $250. Never forget that, never forget that. So you need to have allocation. If let's say if dollar depreciates because of the high public debt levels in US, if a geopolitical crisis worsens any part of the world, gold would do well. But don't extrapolate the recent returns and put all your money in the gold and silver.
So
Don't do that.
Last year everyone was saying moderate your return expectations in equity, and is it that now everyone's saying moderate your return expectations in maybe silver or gold?
Of course.
So because I mean also they've given phenomenal returns, but investors had started treating gold and silver as a growth asset instead of a hedging tool, like how you said.
But remember one thing, that it's basically that people want to diversify against dollar, and they're not like many other places or many other currencies which are like ready to take that mantle for variety of reasons. And this is a vote in favor of like, let's say, gold, or maybe some people are playing it through digital currencies like Bitcoin, etc. But as I mentioned, that recency bias can at times be dangerous. And go back and check the 100-year history of various asset classes. So never have the recency bias. The asset class that has done the best in recent times is not the one where you double down.
So basically, I mean, keep your money allocated everywhere, not just in one bucket.
And India is I would say, an inherent big beneficiary of the price rise, right? Indians have already been allocating money to this asset class for generations, for thousands of years, since time immemorial. And imagine the wealth effect it can have. And over a period of time, as people start using this as a collateral to kind of invest more money into productive assets, this can be good for the country.
You mean money can not only come from, the reforms like GST, etc., but it could also come from this end? Like
it's giving a huge wealth effect for sure. It's just that, it's very interesting. When people have a gain in their equity portfolio, psychologically they feel a wealth effect and they spend more. They will spend more on their vacation, more on their, let's say, anything that they are buying, because they feel good, they see the balance. To some extent it is there with real estate also. But in case of gold, it's very interesting. Maybe it's in our psyche for thousands of years that our lust for gold is so deep that when prices go up, you don't feel good. You know why? Because you think that you have a lot more to buy. And it's interesting. I just hope at some point in time, Indians think the same about the equity market. That when prices go up, they feel, oh my God, अभी तो बहुत निवेश करना है मेरे को. So बहुत ज़्यादा भी ऊपर नहीं चला जाए. Gold में it's very interesting that when prices go up, whatever amount of gold that you have, you don't feel the wealth effect and you don't spend that money because you think that अभी तो मेरे को और खरीदना है अभी life में, right? Equity में same होना चाहिए. Most of the investors ultimately will be perpetual investors till the time you really need that money, right? I mean, India is a country which is growing, will give you higher income, you will have more wealth, you will invest more. But people still feel positive when they see a higher balance. In equity, they don't. I hope it changes.
I think that is something that to aim for. And how, so I mean, this was an interesting point that you pointed out. So for to reach that level, so how much should penetration increase? Because penetration for mutual
equity,
funds, yeah, for mutual
still
funds is
so
so
low.
low.
There are only 5.5 crore unique investors, and if you look at the demat account, there are probably maybe a few crores more. In fact, it's interesting. In our industry, we keep thinking that there are still crores of investors who have invested in stock market. They might have participated in IPOs, might be doing F&O, might have invested in stocks directly. There are tens of crores who were doing gaming and trying to make quick money while knowing that they may not create wealth. A lot of these investors are potential investors for us. At HDFC AMC, our minimum amount is 100 rupees in several of our equity funds. So you can start your journey with as little as that. The amount of money that you were putting in gaming, you can start with the SIP.
So that was that with Mr. Munot. There was one clear takeaway from the conversation is that slow and steady doesn't just win the race, but it stays in the race. So thanks for watching and happy investing in this Samvat.